If you trade the Canadian dollar, one institution controls more of its direction than any other. That institution is the Bank of Canada, and most retail traders pay far too little attention to it. The Bank of Canada, known as the BOC, is Canada's central bank. It was established in 1934 and has been shaping the Canadian economy ever since. For Forex traders, it is the single most important driver of CAD pairs like USD CAD, EUR CAD, and GP CAD. So what does the BOC actually do? Its primary job is promoting the economic and financial welfare of Canada. It does this through four main areas: monetary policy, financial system stability, currency issuance, and funds management. For traders, monetary policy is what matters most. At the heart of that monetary policy is something called the overnight rate. This is the interest rate at which major financial institutions lend money to each other, overnight, on a short-term basis. The BOC sets a target for this rate, and that target flows through the entire economy, affecting mortgages, business loans, savings rates, and ultimately the value of the Canadian dollar itself. The BOC's Governing Council meets 8 times per year to review economic conditions and decide whether to raise, cut, or hold that rate. These meetings are scheduled well in advance so traders can prepare. The council looks at inflation data, employment numbers, GDP growth, and global commodity prices. That last one matters more for Canada than for most countries. Canada is one of the world's largest oil exporters, so when oil moves, the BOC pays attention. The bank also maintains an explicit inflation target of 2%, within a range of 1 to 3%. When inflation climbs above that target, the BOC tends to raise rates to cool things down. Higher rates generally attract foreign capital, which strengthens the Canadian dollar. When inflation falls short or the economy slows, the BOC may cut rates, and the dollar often softens as a result. Several specific events move CAD pairs hard. The 8 annual rate decisions are the biggest. Even when rates stay unchanged, the policy statement that accompanies them can shift sentiment fast. The quarterly monetary policy report offers deeper forecasts and often signals where rates are heading before any official move. Governor speeches carry weight too. A single phrase about future policy can trigger sharp price moves within minutes. Oil prices add another layer. Rising oil tends to support the Canadian dollar. But if rising energy prices also push inflation higher, the BOC faces a more complicated decision, and the market reaction becomes harder to predict. Trading always carries risk. Only put capital at risk that you can genuinely afford to lose. The practical takeaway: mark the 8 BOC decision dates on your economic calendar now, then watch how US CAD reacts to each announcement. Pattern recognition built around real events is far more valuable than theory alone.